Hi everyone, I'm America Josh and welcome to US Taxes and Expat U, Learning to Love Tax Time by Aussie Recruit, Uptrend Advisory and myself, America Josh. Thank you very much for joining us today, this afternoon. We put this webinar together each year because just like you, we moved to the US from Australia in our cases, and amongst everything else that we had to sort our lives, taxes were something that we had to consider. And it's a difficult space and an interesting space and something that we can make exciting in this meeting, no doubt. As someone who personally, I have absolutely no idea when it comes to tax time, I could have benefited from something like this where I got to submit some questions and ask some questions of a professional 4 years ago when I arrived. Because I've seen how difficult it can get for a lot of people. I get a lot of emails, and myself filing taxes from 2 different countries can prove to be very difficult. The group of us, the 3 of us, have spoken to thousands of Australians who have asked similar questions, and we thought bringing a professional in to answer them was the best way forward. So whether you've just arrived here or you've been here for years and want to make sure that what you've been doing is correct, we've designed tonight around all of you. So here's how it's going to work. In the next hour, we're going to go through a range of topics that you've all asked about. We had around 210 questions submitted, and we've divided them into a number of categories, ranging from a really broad overview of tax requirements to questions of tax residency, 401ks, superannuation, FBARS, foreign assets. We've worked hard to try and answer as many of those questions as possible with general advice that's applicable to everyone. Amy and I are going to each take turns asking Jason questions, and we'll take it. Jason will take it from there. We'll finish up everything in right about an hour. So can I first introduce Amy Meyer from Aussie Recruit, who will introduce Jason to kick us off.
Thank you so much, Josh. Hi, everyone. It's great to see you either again or be meeting you for the first time. My name's Amy, and I'm based out here in San Francisco. I run an Australian expat community out here, and as Josh mentioned, also Aussie Recruit. So really happy to be with you here today. Tax is such a common pain point for us expats out here. I moved out here 8 years ago from Sydney, and I'm still going to Jason all the time with the most random questions that keep coming up and popping up over the years. So really grateful myself to be having these sessions annually to get all the latest information and understand what's changed over the past year, if anything, or otherwise just a really good refresher. As Josh mentioned, I run Aussie Recruit out here. I essentially help Australians get jobs at E3 friendly companies in the US. So that's what I'm doing day to day, and also creating these sorts of resources to try to help Australian expats make their way in the US. So again, thanks so much for joining us today for this 1-hour session. And I would like to introduce our guest speaker for today, Jason. Jason is the managing director of Uptrend Advisory, and he's based out in San Diego, and he is going to introduce himself now. But thank you so much, Jason, for joining us again.
Thanks, Jason.
Yeah, thanks, Amy. Thanks, Josh. I'm really excited to host this webinar with both of you again, as last year really did help a lot of people. For those of you who don't know me, and if it isn't already clear, my name's Jason Stark. I'm a chartered accountant in Australia and a CPA in the US, and I'm the managing director at Uptrend Advisory. At Uptrend Advisory, we specialize in helping Australians living in the US, as well as Americans living in Australia, navigate both countries' tax systems. So as a CPA and a chartered accountant, I know tax is complicated. And then if you're someone who doesn't have that background, having 2 layers of taxation just makes it even worse. So I'm hoping that, this webinar will help answer some of your burning questions. I want all of you who are watching to know that I did read through each question that was submitted and would love to be able to answer them. However, as we only have 1 hour today, it's just not possible. And so we're kind of trying to cater to the majority of you. I'm also conscious that those of you watching will have varying levels of comfort and knowledge of the US and Australian tax system. So as a disclaimer, this webinar is intended to provide a basic understanding of how the taxes work in the US, and some of these answers may not apply to you. If you want to be sure about your specific tax question, please reach out to me. Over to you, Amy.
All right, excellent. Okay, so let's get started, Jason. It's my first time doing taxes in the US. What should I be doing them, and how do they differ from an Australian tax return?
Yeah, so The first difference is that the US tax year is on a calendar year basis with a December 31 year ends when compared to Australia's June 30 year ends. In America, your taxes are due April 15 of each year. So that would mean right now, April 15, 2021 is for your 2020 tax year. And you can either file these returns through an accountant like myself, or you can prepare them through a software like TurboTax or SprintTax yourself. The only thing I would caution is that some of these softwares don't cater to non-residents if you are a non-resident, and they also rely on you knowing what you need to submit with your return.
Okay, great. So do I still need to file Australian tax returns while I'm living in the US, like living and working in the US?
Yeah, so this would really depend on your own situation, but if you spend all of your time in the US, you may no longer need to file, or at least need to file a non-lodgement in Australia. If it is your first time in the US, but you spent most of your time that year in Australia, you would need to file as a resident for tax purposes in Australia. If you have income from Australia, such as a rental property or HEX debt, you will have an ongoing Australian filing requirement, even when you're a non-resident.
I mean, that leads to my first question, because you keep mentioning resident, and I know it's something that comes up a lot when people ask me questions about tax, and I quickly divert them to you, Jason. But being a resident or a non-resident of a country, so how do I know for tax purposes if I'm a tax resident of the US?
So that's probably the most important question with everyone's tax situation, because whether you're a resident or a non-resident will completely impact on how your tax return is completed. So to be a resident for tax purposes, you either need to have an immigration intending visa, such as a green card, or have passed what's called the substantial presence test, which would mean having been in the US for over 183 days in the calendar year.
Okay, so if I'm a resident for tax purposes in the US, what types of information do I need to include from my Australia on my US tax return?
If you are a resident for tax purposes, you would need to state your worldwide income, which in this case means your Australian income, be it, investment properties, shares, dividends, interest, and the like. You may also have to state your foreign assets if they're above certain thresholds. And this would be things like your shares, your super, your savings, and your mortgage offsets, all of those types of things.
Okay, so that was if I'm a resident of for tax purposes in the US. What about if I'm a non-resident for tax purposes in the US? What types of information do I need to declare?
So it's a much easier situation because if you're a non-resident for tax purposes, you only need to state your US sources of income on your US return. So US employment income, US stocks, US dividends, US property. Everything from Australia would be out of scope on your US return.
Okay. What about if I'm a non-resident that we just discussed, but I'm married to a US citizen?
So if you are married to a US citizen, you can elect to file what's called married filing jointly, which means you're submitting one combined return together. This would allow you to potentially be in a better tax bracket for US purposes. However, this would make you a resident for tax purposes and then bring what you've got with regards to Australia in scope for your US tax return.
You mentioned before green cards. So what's the sort of the succinct, if you do get a green card, what are the tax implications of getting that green card?
When you have a green card, you will always have a requirement to file US tax returns, whether you're living in the US or have moved back to Australia. So even if you move back to Australia, you would still be considered a resident for tax purposes in the US and would have to state your worldwide income and foreign assets. The other implication is the long-term implication, where if you've held a green card for 8 years out of the most recent 15 and want to one day give up your green card, you might be in scope for what's called an exit tax, which would be based on your net wealth.
Okay, so there's significant implications to think about before going down the green card path. I know a lot of people, due to COVID and just sort of generally, might have moved states within the United States. So if I'm normally in New York and I've moved to California to get some sun and avoid all these sirens outside, what do I have to do if I've moved states internally for tax time?
Yeah, so you'll likely have what's called a multi-state return to do come tax time, where your income is split between the two states as opposed to only having to do one state return. This can get a little bit complicated as some states allow credits for taxes that have been paid to other states, while some do not. So if this is something that applies to you, I would not recommend self-filing if you have moved states within the year.
Okay, and does that sort of similar concept apply if I know a lot of people have traveled internationally, potentially even back to Australia to live and work, but if they're working remotely for the US company, what changes then? Is it similar?
Yeah, so if you've gone back to Australia and you're still working for your US company, you would still have a federal return to do. However, depending on how your company's
US federal?
Correct, yeah.
Yep.
Yeah. However, depending on how your company's payroll department works, you may only have a federal return to do, or you may still have to also do a state return to do, because if they've given you a W-2 that says you've got California sourced income, even though you're not working there, you would still have to file a return for that state, because California would be getting a copy of that W-2 and expecting you to file. So, if you are living in Australia as well, in this situation, you would then also have to report this income on your Australian return. And then that's kind of where the tax treaties come into play.
Okay. You mentioned before, and we're talking about traveling between countries, and you mentioned before that the financial years are US's calendar year and Australia is July, June. Is there a best time to move? If I'm going to go back to Australia, or if I'm going to move to the US and I can plan those dates, is there a best time to do that?
Yeah, so this one is where it's completely case by case, and it's not something that's got a black and white answer, as it depends on whether you've got things like shares or RSUs or properties or other kind of big rocks to consider and capitalize on. So if you are considering making a transition like this, please consult an accountant like myself for specific advice for your situation.
That's a good segue into my question, Jason, about Australian investments. So you did just mention that you might have property or those sorts of things, maybe in the US or maybe in Australia, but this particular question is more around resident taxes. So let's say I have Australian investments and income while I'm out here in the US. For example, an investment property or capital gains from selling shares or stocks. How should I be declaring these on my US tax returns?
Yeah, so if you're a resident for tax purposes, you should be declaring them on your US return. So you would report the income and expenses from your property for the calendar year, including any mortgage interest and property depreciation. When it's capital gains, you would list, the stocks at the price you bought them, the price you sold them, and then the appropriate gains and losses from them would flow through naturally on your return.
Then I'm thinking about the tax treaty between the US and Australia. I think there's generally a lot of questions I see around
so much confusion
about double taxation. I've been hearing it for 8 years now, so maybe you can set the record straight here. How will I avoid double taxation on these sorts of incomes? Is there any double taxation? Obviously, we don't want to be paying tax in 2 countries if we don't need to, so please educate us all on this.
Yeah. Australia and America do have a tax treaty which prevents double taxation between the countries. So if you pay tax in Australia on your investments, this would then be leveraged directly on your US return, your US federal return, as a foreign tax credit to offset what the IRS calculates. The same would apply if you pay taxes in the US on US sourced income and you're a resident for tax purposes in Australia. You would simply state your US income and US tax paid to the ATO, which would then create a credit to offset what Australia calculates. The one thing to note, though, is that when we're talking at a state level, so California or New York, each state has its own view of whether it conforms to that tax treaty or not. So if you're in a state that does not conform to that tax treaty, you will be taxed again on your Australian sources of income. So for example, unfortunately, California and New York do not recognize that foreign tax credit. So if you had that rental income or that capital gains from Australia, please be aware you will be paying additional tax at that state level.
Taxes everywhere.
Yeah.
Yeah.
You mentioned before, Jason, that like if you're a resident for tax purposes, we'd have to be stating those foreign assets. So what do we need to state? Like, is there a sort of a list that we need to state, and how do we do that?
Yeah. So if you have over 50,000, yeah. So if you have over 50,000 US dollars worth of foreign asset, and what I mean by this is it's not American and it's not property, then you would need to complete what's called a statement of foreign accounts in your
Hold on,
American
Jason,
returns.
sorry.
Yeah.
Can you start that answer just one more time? Sorry, just it broke up a little bit, and I think I missed I heard sorry. So if I am a resident for tax purposes, we would like, how do we state those foreign assets?
If you have over 50,000 US dollars worth of foreign assets, and in this case, foreign means non-American and not property, then you would have to state them through a form that is the statement of foreign accounts in your American returns. And you would state the amount of income that you've received from them, so dividends from shares or interest from bank accounts, as well as, you know, the actual account balances. You would not be taxed on the value of these account balances. It's more so the income sourced from those accounts. And that is when the tax treaty would come into play to, you know, create tax credits based on, you know, what tax you paid on your interest income, as an example. Outside of your US tax return, if you have over 10,000 US dollars worth of foreign assets, you would have an obligation to complete an FBAR, FBAR, which goes to another government agency who focuses on crimes and enforcements. This can be filed very quickly on your own through a portal. It will probably take, you know, the average person 10-15 minutes, and is due April 15 each year. This form would mirror that other form that I just spoke about, but you're not having to state the interest or dividends tied to those accounts. It's purely what is the accounts, what is the balance, and that's it. There are other special forms, and I don't want to go too into it, that would need to be filed if you have special vehicles in Australia, such as trusts or legal entities. But if you have those, just please flag that with your accountant, because that does trigger other things.
Okay, so you've got the FBAR, which is just a reporting of basically sharing, like, I've got bank accounts overseas, and that's set, like, you just have to do that, and it's if you've got $10,000 over all of the accounts combined or more. And then there's the tax one, which is separate from that, which is actually, you know, paying taxes and interest and making sure that you're ticking all those off. So let's hypothetically say that I should have been filing those things, and I didn't file those things. And I didn't tell, you know, the tax or FBAR, or, you know, is there something I can do to correct that? Are there fines if you don't do that, or is it just sort of, you know, go back?
Yeah, so it depends on what was not included but should have been included. So, you know, if you missed some of your foreign assets or foreign income or foreign forms, there are IRS amnesty programs, such as a streamlined filing program, that you can go through to get back into compliance. But all of this is hinging on the fact that your original mistakes must have been as a result of misconduct. So if you don't do anything about this and just let it go, there can be harsh penalties put on you by the IRS if they do discover these facts. So, you know, if you fall into this situation, please reach out to me directly and we can discuss your options.
No.
Jason, I think I'm slow on my FBARs. I think it took me over an hour the first time I filed my FBAR. Not 10 or 15 minutes,
10
but
minutes,
I will set
like,
that goal this year. I actually created a spreadsheet with all of my accounts, and every year when I need to file my FBAR, I just go back into that spreadsheet and update it, and it saves you so much trouble from having to go figure out what accounts you have, what account numbers they are, the mailing address of the institution or whatever it is. Yeah. But I've got a goal of 10-15 minutes for this year.
Yeah, no pressure.
All right, so we're going to switch over to superannuation now. We've all heard very different opinions. Well, I've heard very different opinions on the treatment of superannuation and when you're a resident for tax purposes. Can you share what you know about this?
I guess the reason why this is so gray and there's no black and white answer is that, you know, we've just talked about the tax treaty, but superannuation has not been explicitly named in that treaty, which leads every accountant to have their own opinion on how it should be taxed. So I guess what it boils down to is if the IRS would consider superannuation to be, in the technical terms, a foreign granted trust, it would be viewed to be as taxable. And this all comes back to the concept of control, if the individual had control over their superannuation. Now, control can mean many different things. So control can be choosing where you have the ability to invest your superannuation, which all Australians do. Control can also exist when you have made the choice to make contributions to your super funds over what your employer does. As you know, the IRS has not made any rulings on what constitutes control for superannuation. It is really up to interpretation. So a potential argument for control is that, you know, if you've contributed more to your super funds than your employer has, you know, at that point, you've got more control over it, in which case it would be viewed as a foreign granted trust and taxable. Whereas if it was just, you know, an employer-sponsored super funds and you haven't made contributions to it, in that case, you know, some firms might just state the balances on the appropriate forms, but not treat it as taxable year over year. If your super funds was a self-managed super fund or an SMSF, then the IRS would deem it to be a foreign granted trust. So I hope that, you know, you all can appreciate how gray this is. It is something that's evolving year over year as more opinions come out, but until the IRS kind of just come out and flat out say like it's taxed or it's not taxed, you're going to be kind of in this gray situation. And I guess, you know, on the flip side, with the US version of super, so 401k, the ATO does not recognize it as a foreign super funds. So similarly, 401k is not called out as taxable or not taxable in that tax treaty. So there are two rulings in Australia from the ATO that, you know, have essentially declared 401k as taxable. So if you're interested in that, those rulings are publicly available if you Google them. But in summary, you know, superannuation is an asset that is stated in your foreign asset forms. However, the taxation of it is still evolving and really depends on your accountant's interpretation.
Okay, great. Thanks for the extra info on 401.
The one thing to note just before I ask another question is we are recording this webinar. So I know, you know, there's a lot of information and a lot of like things that will sort of wash over you a little bit, but it's worth watching the whole thing and then coming back and you can review what Jason has told us, because we'll release those videos afterwards. Jason, on that, there'll be some people that have Hex Help or Hex Loans from Australia, so taking student loans, and then they might still have some value left in them. What do I do if I have Hex Help and I'm living in the US now?
Yeah, so if you do have Hex or Help debts, you will have to file an Australian tax return each year based on your worldwide income, even though you may be a non-resident for tax purposes in Australia. And the purpose of this is to allow the ATO to calculate what debt repayment would have been owed on your income if you had lived in Australia. So this isn't really a tax thing, but it's more of a debt collection mechanism for them.
Gotcha. The banks in Australia, and I know I've seen these forms flying around a lot, the W8 and the W9. I know I've had a lot of people asking me, you know, why have I been sent this and what do I have to fill in? What's the difference between a W8 and W9, and do I have to complete them, and which one do I have to complete?
Yeah, so these two forms, you know, simply instruct your bank or other provider to account for any taxes that have to be withheld on your behalf based on your residency. So if you are a US resident for tax purposes, you will complete a W9. Whereas if you're a non-resident, you complete a W8. That's it. It's pretty simple. Yeah.
Awesome.
Great. So with COVID impacting so many people last year, Jason, has the US or Australia given any sort of special tax deduction? Did you grab that question?
So
Okay.
Yeah.
Just checking. There was a bit of a lag there, so I just wanted to
Yeah.
make sure.
Looked like
that
you were having a quick nap there, Jason.
really think
Froze with your
through
eyes
the answer
closed.
to that question. Oh, it looks like
Oh, no.
maybe. Oh, you're back, Jason.
yeah, I'm back. I'm
Okay,
back.
great.
It was a bit of rubber banding there. But I did catch the question. So, you know, outside of taxes, the US did give people that were eligible stimulus checks and will be giving more for anyone that's followed the news. In terms of, taxes, the US is allowing people who take the standard deduction, additional deduction for charitable donations. So if you're filing as single or married filing separately, you will get a $300 charitable donation if you donated that amount. If you're filing married, you can get a $600 donation credits. And then something that's also brand new is called the recovery rebate credit, available in your 2020 returns for those who are eligible based on the stimulus payments they received in 2019 or did not receive. So it's a last opportunity to kind of catch up on what you're owed. In terms of working from home deductions due to COVID, the IRS, unfortunately, is still only allowing those who are self-employed to leverage that. Australia, though, is allowing a COVID working from home deduction. Expenses incurred would have to be work-related, though. I can't,
Jason, we just lost you for a
I
second
bought a new
there.
car.
We just lost. So you were saying that Australia, however, has allowed a working from home deduction, and then you said something else that I think missed.
Yeah, sure. So Australia is allowing a COVID working from home deduction at either an hourly rate or an actual expenses incurred. And the expenses incurred would actually have to be work related. It can't be, I just bought a car, oh, that's work related. It's got to be for purpose.
Okay, great. Okay, good to hear on that. So we're going to talk about 401ks now. So if I have a 401k investment and I want to move back to Australia, which I know many Australians have been doing, especially throughout 2020, what should I be aware of from a US tax perspective if I want to withdraw from that 401k?
Yeah. So if you are under the age of 59 and a half and want to withdraw money from your 401k, you will have to pay a 10% early withdrawal penalty on whatever you draw. And then you will pay regular income tax on the amount that you withdrew. And, as I flagged earlier, if you're doing this well in Australia, the ATO will want to tax that. So you're almost facing 3 levels of tax in that situation. You've got the 10%, and then the ordinary tax, and then whatever Australia wants on top.
Okay. And can I withdraw my money from my 401k and put it into my superannuation tax-free?
So you can, however, depending on your age, there may be those withdrawal penalties that I just talked about in the US, and then potential contributions tax when transferring it into your super, which is also age dependent. So in Australia, if you're over 65 and want to contribute your 401k to your super fund, there are various tests that you would have to pass. And then that transfer amount would be capped each year before it's taxable. If you're 64 or under, there's a different cap and different rules that apply.
Okay, so what I'm hearing are there are exit penalties with early withdrawals. So if you're an Australian living in the US, working in the US, is it worth contributing to a 401k if you know or envision yourself, moving back to Australia, either in the near or like long term?
Yeah, so this is kind of a more financial advice based question than a tax question. And it really varies on the factor of, firstly, how much is in your 401k, what is your match? What is your contribution? How many years are you doing this? And what you plan on using it for. For example, withdrawing to invest in your super or to invest in another assets that generates a return might be a better option if investing in those alternative vehicles gives you a better tax benefit than investing in 401k when considering in the withdrawal penalties. It's definitely something that can get a little bit complicated and can become a complex exercise. So I would recommend that you talk to a financial planner about this, because it's so specific to your situation and what your life goals are.
Okay, great.
So if I, legally am allowed to, and it's important to flag that because a lot of people listening are going to be on E3 visas who can't work for anything other than their employer. But if I am not on an E3 and I maybe have a green card and I want to start a business in the US, how does the tax work for sole proprietors?
So this works very similarly in the US as it does to Australia. When you're a sole proprietor, different structures have different requirements, but on your US return, you would essentially complete a form that is your business's profit and loss statement. And what I mean by that is your business's income less the expenses to arrive at net profit or net loss, hopefully not net loss. You would then pay a self-employment tax, which varies state by state on the business's net income amounts. And then outside of that, it would flow through to your return and you'll pay ordinary tax based on which tax bracket you sit in. Now, that's all easy, but what a lot of people forget about is the compliance piece, which is that as you're self-employed, you are responsible for withholding your own taxes and making quarterly payments to the IRS at the federal level and the states, if that state collects state income tax based on your income for that quarter. There are a lot of resources online to help you with this, or you can work with an accountant like myself to assist you. And then the other thing as well, just to flag, is that, with the expenses, there are certain things that you should be cautious of how you expense, such as, meals and entertainments, because if they're not for business and you get audited by the IRS, you're probably not going to have a good time.
Okay, so all the champagne lunches are, knock them off the list. If you mentioned sort of consulting with a tax professional, also wondering about the fact that Australia and the US, like we touched on before, have differing tax years. How do we sort of manage if you've got different filing requirements every sort of effectively 6 months?
Yeah, so there are one of two approaches that you can take, or you can just do nothing about it and file every 6 months. But you can file an extension in one of the two countries so that it aligns with the other country's due dates. So if you file an extension in the US, your deadline is October 15th, which is close to the Australian deadline. And then, if you're doing, your US return and you're not filing an extension, you can prorate your Australian income to, a calendar basis year income, as well as the tax paid to use on your US tax return. The US does allow you to accrue a foreign tax credit based on the tax that you'll end up paying to the ATO, even though you might not have paid it yet.
Okay, so that extension that you mentioned so that you can line things up, is that something that you file every single year?
Yeah, you'll have to file it every single year if you want to have that extension granted. It's not something that you can kind of opt into and have it in perpetuity.
Okay. In addition to that, with the different countries, if I've got income or if I've got values of bank accounts and things in Australian dollars, and I need to report in US dollars on the US tax documents, what foreign exchange rate do I use? Is there a particular number or?
Yeah, so the ATO and the IRS both have exchange rates on their website that you can use. You can use either of them. The key thing though is to be consistent with what rate you use in a year. So pick one of them, not both, because they're different, or don't use Google Finance and then use the IRS in a different section. The key is consistency.
Okay, awesome. Yeah, cool. Okay. The other one we've got that we had a few questions about was around inheritance tax, and wondering, do I pay inheritance tax basically if it's from Australia?
Yeah. So generally speaking, if the deceased estate portfolio only consisted of Australian assets, then you would not pay inheritance tax. If it does include US assets, then you may have to pay tax on it. So, if this applies to you, because it is one of those complex areas, please reach out to myself or another accountant to help discuss further and give you clarity on what your obligations would be.
Awesome.
So Jason, what are some of the biggest mistakes that you have seen in past returns?
Yeah.
Feel free to not hold back on this, because I've heard a lot of stories and read a lot of posts in our Facebook groups about this, right, Josh?
Yeah, we've read a lot, and I think we see a lot of people that are, effectively saying, like, you don't need an accountant, and we're not going to say, you have to at all by any stretch. That's not the point of what we're doing today. But it's sort of, what are the things that you see that are things worth flagging, and reasons that there is an advantage to coming to someone?
Yeah, I mean, everyone's human. You only know what you know. So, some of the common mistakes I've seen is, not using the correct filing status, resulting in overpaying taxes, missing information such as social securities or supporting documents, such as W-2s, which aren't a big mistake, but can create delays from the IRS to process your return because they'll send you a letter asking for the information. Math errors, thinking, you can deal with Australian returns, well, Australian income only on your Australian return and your US income only on your US return, and not considering the overlap when you have to. Not taking advantage of deductions that you're eligible for, such as child tax credits, filling in the wrong forms or just missing forms. And I guess the worst one is just not filing at all.
So yeah, the number one take home for today is make sure you file your taxes. Just wondering, so should, on filing and whether you can do it yourself or not, should you have the same accountant in both countries, or is it okay to use, one company and accountant in the US and one in Australia? Like, what's the general advice there?
Yeah, so I don't see an issue with it as long as both accountants have an understanding of how the one hand feeds the other. And what I mean by that is how what you do in Australia impacts the US and how what you do in the US impacts Australia, because you might end up creating an issue for yourself if that isn't considered. For example, if your accountant in Australia is wanting to set up a trust for you or set up a proprietary limited, that will create implications on your US return, which can be costly if it's not structured in the right way. So to that end, it would be important to have, someone that deals with both. But as long as, the Australian accountant understands the implications in the US side, then you can have two separate providers. It's when there is that disconnect that there may be issues.
Gotcha.
So do you have any last advice for everyone here that's joined us today or is watching our recording later on? Any advice as people are getting ready to do their taxes?
Yeah. So I would say, preparing now is a great idea, as it will put you in the best position for tax returns for a number of reasons. It gives you time to collect all the documents you need. Often, people start the process too late and it can become very stressful, can delay the process or create further issues. Personally with my clients, I've started reaching out in December to kind of, hey, here's everything I need so that you've got ample time to be ready. So I guess it's also important to keep in mind that if you do decide to file your tax returns with an accountant, that this is the busiest time of year for them. So it's important to secure them right away, as opposed to trying to engage someone in a few months' time when it's already the deadline.
What happens then? Like,
yeah, we're just going to call you in March, Jason.
Is that our problem or is that your problem?
So every, accountant might be different. And I guess it comes down to capacity. So, speaking for myself, let's say I'm very, very busy in March and, I've planned out the rest of my time till the deadline. I might not take you on as a client just because I don't have the time. And I wouldn't want to take you on as a client and rush your return if I know it's going to need to take more time because there's complexity. So in that case, I would tell you to find another accountant, which, is fine, because if you find someone, that's great. It's just not one of those things you want to leave to the last minute.
Awesome. I think there was I just noticed, I was having a quick look through the questions and noticed there was one here just about your tax file number in Australia if you can't find your tax file number. Jason, do you know if somebody needs to recover that, if that's something easily done? Is it?
Yeah. So if, you can do one of two things. If you have an accountant, they can liaise with the ATO to get your tax file number. Alternatively, you can just call the ATO yourself, verify yourself, and they'll give you your tax file number.
Cool. And there was one other question just while I'm just going through quickly. We were talking a lot about 401ks, and I know one thing that I've seen pop up when looking at employment options and benefits and things, and this may come down to a financial planning thing more so than a tax thing. But is a 401k treated the same way as an IRA and Roth IRA, or are they sort of all completely different houses and yeah, should be treated separately?
So, are you talking about in terms of how Australia would tax them, or just how they? Yeah.
I think in relation to we were talking about how 401ks are treated in Australia. So is that the same if someone here has an IRA?
Yeah. The language that's used in the private rulings is what they call the excess of corpus, which is essentially the growth on your contributions would be taxed.
Cool.
Regardless of what funds. Yeah.
Jason, I've also had a question here sent to me, and just since we have a little bit of time, I just want to ask you, someone's asked how much they should expect to pay an accountant for a US return. I'd imagine there's potentially a wide
lot
range
of variance.
but maybe you can just give some indication about what you'd pay using an accountant versus say maybe one of the softwares like doing it yourself, TurboTax or something like that, just some sort of indication.
So it's one of those ones that's really hard to answer because I know with my firm, for example, we quote based on the forms that are required. So, a return that is just the W-2 is cheaper than a return that has, W-2 income plus properties in Australia, plus shares, plus a trust. It's also custom. But generally speaking, the turbo taxes will be cheaper because you're doing most of the legwork. But obviously that comes with the risk that you need to know what you need to put in. Whereas, other firms will kind of hope to discover your variables and hope to uncover what forms are needed and then quote you based on what they think will need to be done. As in terms of like pricing, it's so far. It's so wide ranged. I believe Turbo.
Completely depends if you're going to file. If you're going to rock up and just have your taxes, then and you just got one employer, then that's obviously substantially different from someone with income coming from two different countries and.
Yeah.
Hey, one question that just came in, and
I'd love to say, oh, it's $500, but it's. Yeah.
Sorry, I cut you off there. Yeah. The one question, and sort of broadly, sorry, I'm just reading it now. Social Security number. Do you need a Social Security number to file a tax return in the US?
So you would either need a Social Security number or an individual taxpayer identification number. And you would be issued, and if you're ineligible for a Social Security number. But I guess you do need one of those two things to be able to file a tax return in the US.
Gotcha. Cool.
Oh, Jason, we lost your face. You're just a big jet. Oh,
Oh, there
you're
you
back.
are.
All right. Josh, have you got any more questions there?
No, I'm good. That's I've reached, I think, the end of my list.
Excellent. Great.
Great.
Cool. Well, thank you so much for everything, Jason. We really appreciate another year of excellent content. Thank you to you. And yeah, Josh, did you have any kind of parting words you want to share too?
No, I think we had a few questions about, following up, and I know some people have sent in specific questions, and they've sent in, we had a lot of questions that were very particular to an individual. I've got a fiance and I'm applying for a green card and I want to get my 2 kids to make sure that and we absolutely tried to take all of those questions and distill them down to their essential bits. But the best way that you can sort of move forward is reaching out to Jason, and that's exactly what he does, and asking those particular questions, because I think, as Jason said at the very top, it's important to know that every single person's tax is completely different from every other person. So there aren't always hard and fast rules that apply. You should all just fill in this one form, because turns out, if, as Jason was mentioning before, if you have more than $50,000 worth of assets, suddenly you've got a new form that somebody next to you might not be filling in. So I think it's just making sure that you've this is where the value comes from, having these conversations, and then knowing what to expect and what you should be doing and what you should be thinking about. But no, thank you, Jason. Really appreciate your time.
Yeah, and as Josh mentioned during our sorry, Jason, go ahead.
No, it's okay. It's okay. I was just going to say thank you, guys. It's been really fun again.
Great. And as Josh mentioned, we do have a recording of this session, so look out for a follow-up email from us that will have a copy of this recording, and we'll also have a brief survey. We love to provide you with resources that help you as an expat out here. We are all expats here on this call, Australian expats, so we feel the same pain points. So definitely reach out to Josh and I if you have other ideas, and you can submit those through the survey for these sorts of sessions. So thank you again to everyone. We hope you have a great rest of the day, and we will see you next time.
Thank you very much, everyone. Thanks.